Apartment REITs, which one should you buy today? We're going to look at a little bit of safety, a little bit of dividend and income, and of course those sweet total returns. So I own one of these. I'm invested into SX Trust. We'll have a look at how that stacks up against the others, and this is a subscriber request to have a bit more of a deep dive into some of these options and to understand which ones might be suitable. Don't forget to hit subscribe now and learn how to become a better dividend investor today. Let's get into it. First off, apartment income REIT. We can see as many companies have had a steep price decline in the last year or so. Dividend yield is approaching 5%, and we can see that dividends are expected to increase incrementally, which is more or less what we expect to see. Dividend payout ratio of about 82% and a BBB credit rating, 64% debt to capital ratio. American Homes for rent, so quite a popular one. BBB again, dividend payout ratio. This is all based on the adjusted funds from operation, the AFFO calculation. So this is looking at a payout ratio of about 52%, so it seems to be very secure. Good debt to capital ratio, but a very low starting dividend yield. But it does look as though there's some opportunity there for some sustained dividend growth. Next up we have Avalon Bay Communities, so one of the very popular ones. We can see here a wonderful A- S&P credit rating, a good 42% debt to capital ratio. We can see a 71% payout ratio and a reasonable dividend yield here of 3.7% or so. And we can look here at the future expected dividend payments as well, and they look to be reasonable increases. Camden Property Trust, another popular one. Starting dividend yield is 3%. It's got again an A- credit rating, a very healthy debt to capital ratio of about 38%. Dividend payout ratio 64%, very safe and secure, and we can see future dividend increases are projected also. Now this is going alphabetically as well, so Equity Lifestyle Properties. And now you can see sort of here, I think the prices are far exceeding the 15 or even the normalized 24 times line. So as I would expect to see, a dividend yield of quite low, 2.4%. No S&P credit rating. The debt to capital ratio is actually a little more elevated than some of the other options we've looked at. They do have a 71% payout ratio, so it's a little bit higher than some of the other options we've looked at. But I think the dividend yield looks, it's quite low, but it looks like there's some opportunity there for growth, and they have some actually quite strong and constant AFFO projections. We'll come back to the opportunities there. Equity Residential. So we see here historically not a huge amount of growth, but a very strong A- credit rating, a good debt to capital ratio of 41%, reasonable starting yield of 4%. And we can see here the dividend payout ratio was 92% last year, about 81% this year. And there is some expectation there of dividend growth, which looks reasonable, but also some reasonable AFFO growth. Essex Property Trust. So this is the only one of the picks that I own. Dividend yield of 4%. We're talking about a payout ratio of about 68%, a reasonable BBB plus credit rating, but the debt to capital ratio is elevated beyond what we've seen on the others, and this is one of the reasons I think that we've seen such a steep decline there. This is something I've got half an eye on, particularly when we consider the current interest rates. If they need to borrow more money at current interest rates, it's going to be reasonably damaging. But overall, we can see an expectation of continued dividend growth as well as continued AFFO growth at this point. Invitation Homes. So BBB minus, a much healthier debt to capital ratio. We're talking about here a very healthy dividend payout of 62%, but a very low dividend yield of 2.7%, and some reasonable dividend increases here expected, as well as reasonable AFFO expectations of about 8% per year. Mid-America Apartment Communities, 3.4% dividend yield, an A- credit rating, and a manageable, I think 42% debt to capital ratio, payout ratio 61%. We can see, I think, some really nice dividend increases expected in the next couple of years, as well as a strong 2023 AFFO growth, some slightly lower AFFO growth than 2020. Sun Communities, Triple B, again, sort of in the ratio there of debt to capital of about 46%. Dividend yield is low. We're talking about some sustained good AFFO growth there of about 6% a year for the coming few years, and some muted, reasonable dividend growth, and a dividend payout ratio of about 54%. And in fact, that looks like they're going to try and maintain a reasonable dividend payout ratio of about that amount in the coming years as well. UDR, so Triple B plus, higher elevated debt to capital ratio here of 55%, nowhere near as high as Essex though. Dividend yield 3.7%. Good 2023 AFFO increases expected of about 8%, followed by 4% 2024. And relatively reasonable, I think, dividend increases there. The payout ratio is a little bit higher here at 70%. Now, really quickly, what I want to do is flick through these and have a sense here of whether or not the analysts are getting this right. So at the top here, we'll have the 1 year forward estimates of AFFO with a 10% margin of error, and the lower panel here, a 2 year forward estimate as well. So flicking through, it wasn't a lot of data on the first option there. American homes for rent, we can see a quarter of the time 1 year forward appears to be wrong, but again, remember they don't have a huge amount of history here. 2 year forward tends to be hitting analyst expectations pretty much all of the time. Avalon Bay Communities misses the estimates by about 17%, both 1 year and 2 years out, so a little bit trickier to forecast accurately. Camden Property Trust always hits or beats estimates 2 years out, and pretty much always does the same thing 1 year out as well, with a miss there being in 2020. Reasonable reason to miss. Equity Lifestyle Homes almost always hits 1 year estimates out. 2 year estimates out is hit 100% of the time, so they do obviously a very good job. The guidance there, as well as analysts understanding the stock very well. Equity Residential, so missing about 8% of the time 1 year forward, and 8% of the time 2 years forward. Essex Property Trust, so always hitting 1 year forward, and missing 8% of the time in the 2 year forward. Flicking over here, that was a historic 2010, and hopefully it looks like they've done a much better job since then. Invitation Homes, so always hitting or beating 1 year forward and hitting 2 year forwards all of the time. Mid-America Apartment Communities, hitting or beating 1 year forward and always hitting it in the 2 year forward, so that's a very good track record there for Mid-America Apartment Communities. Sun Communities, missing it about 17% of the time for 1 year forward, but always hitting it 2 year forward. UDR, hitting or beating 1 year forward and always hitting it 2 year forward. So overall, actually, what we see with most REITs is that the analysts have a fairly good idea. These are fairly easy to estimate the future growth prospects for, and so most of these, we can take these analyst expectations that we'll look at next, and we can use those as a reasonable gauge of what may happen. Wonderful. Now, I want to have a quick look through the forecasting calculator here on Fast Graphs and get a sense of what the possible returns may be for each of these. Now, a couple of items to note here. I'm going to be using the 2024 date here for the end of 2024 for my estimates, primarily because in many cases the analyst estimates, they have more analysts following for 1 year, a reasonable number for 2 years, and beyond that there's often very few analysts, and that will skew, in my mind, the ability for us to get a reasonable estimate here. A couple of other things. Sometimes I'll be commenting down here on the revisions on the AFFO. So the bottom line here is from 6 months ago, what the analysts were expecting, through to the estimate up here for the current estimate. And we can sort of see here, for example, the apartment income REIT, it's gone from about 2.39 down to 2.31, so not a substantial change there. Now we can see 2024 an estimated payout ratio of 82%, which is reasonable, and we're talking about a rate of return on total of 78% and an annualized rate of return of about 34%. America Homes for Rent, we can see a little bit more, I think, here of a slip in terms of the AFFO projections. It looks as though they were expecting fairly strong dividends to be paid out in 2024, but still a healthy 61% payout ratio. If you're looking at where prices are compared to this normalized price to AFFO ratio, the prices are a little bit closer, so it doesn't seem to be as undervalued as some of the other options. We're talking about a 27% total return, or a 13% per annum return. Next up, we have Avalon Bay Communities. So again, there's been a little slip here in terms of AFFO estimates, but not too substantial. We're talking about a payout ratio of about 70%, total return for 2 years almost of 37%, or an 18% annualized rate of return. Camden Property Trust. So here again, we can see a very small slip here in the AFFO estimates. An expected payout ratio of a very healthy 62%, and again a good debt to capital ratio, and the possibility here for total returns of about 38% and annualized returns of 18%. Equity Lifestyle Properties. So again, a sort of a small slip there. We're looking at a payout ratio of about 70%. Note that the debt to capital ratio is a little bit higher than some of the other options. And we're taking on, I think, a little bit more risk there, about 28% rate of return, or 14% annualized rate of return. Equity Residential. So we're talking again slips in the AFFO estimates. We're talking about an estimated payout ratio of a 77%. And here we have a total rate of return of about 40%, or about 20% annualized rate of return. Essex Property Trust. So again, noting, as I said before, the very elevated compared to the peers debt to capital ratio of nearly 100%. Equity, the AFFO estimates, probably a more substantial decrease in the estimates over the last 6 months from the analysts. 2024 payout ratio is estimated to be a healthy 70%. And because of I think the concerns here, particularly around the debt levels, we've got low prices, which leads to an undervaluation and the potential for about a 50% return in total to 2024 end, or an annualized return of 25%. Invitation Homes. Again, a little bit of an AFFO slip there. A very, very healthy 65% estimated payout ratio. A rate of return here in total about 48%, or 22% per year. Mid-America Apartment Communities. So very, very small AFFO estimate decreases there. So I think very good, stable company here. And again, good credit rating, reasonable debt to capital ratio. We're talking about a very healthy payout ratio here of 65%. Now, obviously a very good company. It's not undervalued like the others, with a very moderate total rate of return here of about 13% expected, or only about just under 7% per annum return. Sun Communities. Estimates here for AFFO have slipped a reasonable amount in the last 6 months, but we're talking about an estimated payout ratio in 2024 of only 55%, which is very, very healthy. And potentially here a rate of return of 47%, with an annualized rate of return of 22%. And last but not least, UDR. So again, there's been a slight decrease in the AFFO projections. In fact, here in 2023, we can see they've actually been revised upwards in the last 6 months. So BBB plus, reasonably elevated debt to capital ratio here. So just treat this with a little bit of caution. 2024 payout ratio is expected to be 70%. And the opportunity here for a 41% rate of return, or a nearly 20% annualized rate of return here. So which one of these is best? Well, that's going to be up to you and what you were looking for. Now, what I've got here is a summary table based on the REITs that we've looked at. I am rating these by credit rating. I'm ignoring this Equity Lifestyles without a credit rating. Avalon Bay, Camden Property, Equity Residential, and Mid-America Apartment all A minus. Now, what that means is you can probably get a fairly good sense of security and safety there. They've all got around 40% debt to capital ratios, which is good and safe and the best of the bunch here. Weighted average cost of capital is all about 5 to 6%, which I think is reasonable, and dividend yields here are all 3 to 4%. Of these, I am probably going to take another look at equity residential, which hasn't really come up on my radar before, simply because it appears to have a reasonable starting dividend yield and has a good credit rating. I'll also be looking a bit more at Avalon Bay, and also Mid-America. I'll be looking also, as I do a bit more research into some of the other longer term trends and issues there. Now, if you want to follow that research, do hit the subscribe button and let me know what you think. Which one of these REITs are in your portfolio and which ones might you consider adding? So look, my choices and my preferences are not going to be valid for you. You need to do your own research. This is very much just a quick look at some of these options and some of those factors that I personally believe are most important. Do your own research, dig in deep, find out which of these you like and why. Hit me up in the comments down below. Let me know what you think. Let me know which ones are your favourite, and I look forward to seeing you all in the next video.